Okay. Hi, everybody. My name is Seth Melamed. I am the CEO of Liquid Group. We're a exchange based in Asia, Japan, and Singapore. And I am helping to have a discussion with Mr. Michael Shaulov, who is the CEO and founder of Fireblocks. Michael, how are you?
I'm good. Seth, thanks for having me. Excited to have this chat.
Very excited. So I think we've known each other, I think about 3+ years at this point. And I've really admired how Fireblocks has really spurred the development of adoption of cryptocurrency, and really leveraging MPC in a way that's really, I think, contributed to the growth of the industry. So first of all, I want to thank you for that. Michael, can you start off with maybe a little bit discussing what MPC technology is, and then kind of how you got into it, and then how you got the idea for Fireblocks?
Yeah, sure. So maybe we'll start from the second part of the question, right? And then we'll get to the MPC. I've been in the cybersecurity space actually for a fairly long period of time. I've been almost 20 years. In my previous roles, or actually when I started, I started in the Israeli Cyber Command, and then built a company in the mobile security space, and then basically in 2017, after we got acquired by Checkpoint, that is one of the biggest cybersecurity companies in the world, we were pulled into investigating a breach that happened in South Korea, where if some of the listeners here remember, in 2017, a few exchanges in South Korea got compromised by presumably the North Koreans, and about $200 million worth of Bitcoin disappeared right from those exchanges. So we were part of that investigation team, and I think that was sort of my. I was not I didn't really have Bitcoin at that time. I was not invested in this space, unfortunately. But that was basically my aha moment. That what I sort of realized is that I'm actually looking at the future of the financial markets and the future of the financial technology, and that there were basically significant deficiencies, right, in terms of how things were done back then. And I think that there was misalignment in terms of what the technology was supposed to allow people and institutions to do, right, which is basically the internet of money, to the fact that the only secure way to really keep and store cryptocurrency back in the days was basically cold storage, right? And those things cannot be more contradictory to each other, right? Because sort of if you look at the current financial system or the traditional financial systems, things are connected to the internet, right? People can transact sort of reasonably quickly. It's not that they need to run into a bunker. So when we started to explore how to solve it, we were quite familiar with MPC from different domains, especially around homomorphic encryption, and it's something that is being explored and used in other domains for privacy, etc. And it was very clear for us that this is a fundamental technology that can really move the space in a secure way from this cold storage functionality into being online in a secure way. And in cybersecurity in general, for people that have, even for people that they have an antivirus on their computer, they know that the antivirus starts working and eating up all their CPU in the worst moment, right? So the concept of security, convenience, and speed is usually contradictory. And what MPC really enable us to achieve is to both do things in a very secure fashion, but also by creating the speed and accessibility, right? Now, fundamentally, what is interesting about MPC is that it basically creates a significant advancement on top of what we traditionally call multi-sig, and basically allows us to deploy key management and wallet technology without creating a single point of compromise or a single point of failure, right? Not on the individual level, not on a server level, not on a collusion level, and so on. And basically make it such that a hacker or even an insider doesn't ever have the entire key, and he doesn't have the key of the wallet, not in the creation of the wallet, and not when the signature is generated. And that is really powerful.
Totally agreed. I think it's interesting if I look at Liquid's history with MPC. We were, just like you articulated, we were using a fully cold wallet storage. And when this was about 3 years ago now, and when we're thinking about how do we take our exchange forward and how do we continue to serve clients, we gravitated to MPC, and I think we're really one of the first major exchanges to do so. One interesting thing I would just add is in the industry, we still see that some people haven't fully adopted this decentralized management of private keys. I think as recently as October last year, there was a major incident with one of the exchanges. So, and that I think had probably a chilling effect on the industry. How do you help to get people to get comfortable that crypto is not necessarily something that's going to get stolen or lost, that there's technologies out there to make it a secure means of transference of value?
Yeah, I mean, fundamentally, I think what we're doing here, right? So education and basically making sure that we participate in every panel, every sort of educational venue that exist and explain people in simple terms is the most important, right? So we've done, I think we've done a very significant work in terms of propagating it, right? So unfortunately, for we as Fireblocks, we don't really touch retail or consumers, right? Which I do think that is an important aspect, and I think you guys at Liquid, you guys have done a really great job in terms of sort of propagating this message to the retail. And I read some of the blogs that you guys put that really explains those concepts to the consumers. We mostly focus on the institutional market, and I think where a lot of our time is currently being spent is really working with the banks, working with the traditional financial players that they really want to move into this space. And now they're trying to figure out what is the technology they need to deploy and specifically how they do it in a secure fashion, right? So a lot of our time is spent on that, on the education. The nice thing about maybe that group is that you can actually, they do have experts, right? They do have people that understand at least some of the fundamentals, and you can apply a more sophisticated education, explaining them the concepts. A lot of third-party audits, a lot of those things are basically being thrown into the mix, and eventually sort of walking them through why they can do it securely and so on.
So when you are working with institutional financial organizations, and they're thinking about getting involved in the crypto space, and obviously one of the biggest barriers to entry is simply that traditional finance doesn't have the infrastructure for dealing with cryptographic assets. What are some of the decision points when they're thinking about doing self-custody, using something like a Fireblocks or other solutions out there versus using a custodian?
Yeah, so I think that the question around the sub-custody, or as we call the Fireblocks model, direct custody, is something that requires quite a lot of education, because in traditional finance, I think sub-custody is a very popular model, right? But the main difference between cryptographic assets and the traditional finance is that in this space, or with this new technology, to actually be a direct custodian and to hold the keys that, or at least part of the keys that are in your wallets, is critical, right? And it's critical not only because it sounds philosophically nice, right? It's critical because taking operational risk to a third party in this context can be quite problematic for, I would say, three main reasons. The first reason is that I think that the whole essence of crypto is to reduce counterparty risk, right? And what we really want is to move away from a system where, something like Lehman can happen, right? And some counterparty that is holding your keys, puts those assets on his balance sheet, he goes under, and now you need to basically figure out where your assets are and if you can recover them, right? When you're a direct custodian or when you're using MPC with a provider like ours, we can go under tomorrow, right? With all the keys of our clients are eventually recoverable and accessible by our clients, and there is no counterparty risk to us at least from an asset standpoint. The second and a very important aspect is really to control two operational capabilities. The first one is that most of your operation is being done when you're using a direct custodian. You control most of your operation, which even goes to things like compliance, right? So you don't need to, you can really simplify things and really operate according to your standards without layering in a lot of the things that really annoy users, right? So you can really reach a much better user experience. And the third thing is really to be future-proof and competitive, right? Which is the most important thing on the long run, right? And I think you guys can probably relate to that. Because you were using MPC, right, Seth? You guys were able to roll out more asset support than anyone else because you are controlling your wallet, you're controlling with blockchains you want to deploy. You want to roll out DeFi, you can roll out DeFi. You want to roll out staking, you can roll out staking. You want to do stablecoin, you can use stablecoin. Nothing is basically limiting you from an operational capacity. And you're not bound to the technology stack of a sub-custodian. And I think that innovation and right. The ability to do things in this space eventually creates this competitive advantage, alpha, and better service to clients.
Makes sense. And I think another important point that you didn't touch on, but I followed yourself and Fireblocks very carefully. I think speed is also really important for the aspect of, not just custody, but a big part of the industry and the market is for people being able to move assets very quickly. And I think what Fireblocks has done a great job at, and using MPC has enabled people to have the flexibility to move assets between different venues without any compromise on security. And that's the key. Like, there's no compromise on security, but you're still able to achieve service levels that are quite a bit faster than maybe what a traditional custodian model would offer.
Yeah, because no one else is processing your transaction, right? It's basically eventually in a direct custody model, you're part of the sign-off, which basically doesn't require now 4-eye check on the other side. The other side can basically automate everything, and that really speeds up things, right? So if you look at in Fireblocks, you can emit a transaction in let's say like a second, right? Whereas I don't think there is any sub-custody solution that will actually allow you to do that.
Absolutely. So you touched on DeFi, which I think is the main point of this conference. And I'm very excited because, DeFi has obviously grown since the summer of DeFi last year. And there's, an increasing number of applications and interest from obviously starting off with the DeFi degens at home, and now you have institutions entering in. So how does, your technology and your solution help to grow participation amongst institutions to participate in the DeFi space?
Yeah, so funny enough, we were maybe bullish on DeFi too early. We actually rolled out our support for DeFi back in February or March 2020. We integrated Compound into our into our stack, and you could actually press if you had, for example, assets that are supported by the Compound market, you could just press on a button in the UI. It will basically start generate yield on them by sort of on the back end depositing them into the contract. No one cared. The funny thing was that when we announced it, there was an article on the blog that they basically said at the end of the article says like, yeah, that's like really cool, but no one is going to use it. And then 3 months later, liquidity mining happened, and clearly the entire story changed. And now I actually checked it because we have a board meeting tomorrow. We have 70 clients that are actively using all of our DeFi extensions and capabilities to interact with the DeFi markets. I think that the fact that we went in early and the fact that our customer base was sort of fairly aligned with the DeFi ecosystem really allowed us to build a variety of tools and clearly be very long. So what we really allow our clients today is we are probably the only one that allow this sort of secure generic access for institutions to all the DeFi protocols. We have you can do it through API, you can interact through a browser extension, and you can interact through Wallet Connect, which, at least for me, this is my favorite feature because it's so sleek, in terms of how it works. But the most important thing is that if you compare to the way that, DeFi clearly came from the consumer usage, right? And the most popular tool was MetaMask. And MetaMask is just a very problematic tool for institution, although they now have a product that basically integrates with product like ours. But conceptually, you cannot, as an institution that has millions of dollars or tens of millions of dollars that are deployed into those DeFi protocols, you cannot basically use a wallet in the browser, right? And what we build on top of all of those connectors is all the policy engines that understand the protocol, that are able to create workflows in terms of how assets are being deposited and withdrawn and swapped across all those protocols, and basically create this off-chain workflow that is catered for institutions, and also create to secure the wallet at the source. And to your previous point, I think that the reason why we were so well positioned to do that is that, unlike in CeFi, where there is a lag, or basically the essence of trading with settlement is actually two different things, right? So usually you either pre-fund or you will do post-trade, but to trade, trading is it's a segregated activity. In DeFi, it's the same, right? So you basically deliver on the trade, right? If you want to, and then the fact that we are using MPC and our wallets are in real time, that creates this critical capability, which really allows our users to operate the way that they should without, and I don't think you actually can do it, again, to our previous conversation, using a sub-custodian where you need to wait, let's say 5 minutes or 72 hours, right? Doesn't matter. There is no way for you to interact with DeFi protocols using that.
Totally agreed. I think also, Michael, it might be helpful to talk a little bit about what I think is one of the real breakthroughs of MPC, and how Fireblocks is unlocking access to DeFi for institutions. Going back to the concept of eliminating single points of compromise or failure, one of the very powerful tools that I think has been enabled with MPC and sharding of the keys is that organizations have the ability to create policy that may mimic their internal policies about how they would want to deploy capital, but they can do so in a very systemic, deterministic manner that cannot be corrupted or changed by any bad actor, right? And I've been in banking finance long enough to know that in traditional finance, actually, one person can actually, move funds incorrectly, either intentionally or unintentionally, on their own. Versus, I think what you've achieved with Fireblocks and MPC in general is you can set a policy, and no single actor, nor even if depending on the policy is configured, not even a group of actors could subvert the policy that's been predetermined about how assets could be moved from one wallet to a DeFi or transferred to another counterparty. So when you're working with institutions, what is the level of, what is this sort of the main barrier for them to understand, the idea that they don't actually need a custodian? Actually, the security level may actually be higher than what they're doing today with fiat-based transactions, for example.
Yeah. So I think that I remember that once upon a time, one of our clients from Three Arrows, he tweeted that he wished that traditional finance will look like Fireblocks in terms of the interaction.
Right.
But I think that there are, it's mostly an educational barrier, and to a certain extent there is sometimes also a regulatory barrier, right? So the first one is, you go and you interact with people that have used custodians for 30 years, right? And now you need to explain them why they don't need a custodian. A really good example that I see is that, and it's by the way a non-trivial example. So you have all the market of money transmitters, right? People that are in the payment space and so on. And those are licensed institutions. They work really hard to achieve all their licenses. In the traditional space, they have to use a custodian, right? Because their fiat, their dollars or their yen or whatever the underlying currency is, it has to sit within a bank account, and without having access to to Fed wire or to Swift or something like that, there is no way for them to really operate with the fund unless they want to go and withdraw it from the ATM, right? And in crypto, they actually don't need those institutions anymore, right? Because they can have the wallet, and and if they are, let's say, a money remitter, right? They don't need to go through Swift, or they don't need some very convoluted clearing system that will move their dollars from one side of the Atlantic to the other. They can just use a wallet, initiate a transaction, and whether it's Bitcoin or stable coin or Ripple or whatever, it will basically move to the other side of the Atlantic. And it's very non-intuitive for those people. It's usually sort of when we are having conversation with those clients, it takes them, sometimes an hour to get over the idea that they don't need a custodian. Eventually they get it, and eventually they understand why it's so much more efficient and why this is the power of the technology. But it's non-trivial for someone that was for maybe a lack of a better analogy, was sort of sitting within this like cage for several decades, and now you basically tell them, well, look, there is no cage. You don't need it. You can walk freely, right? You don't need those guys. Right. It's very powerful. I think that the other area where we need more adjustment is clearly regulation, especially, for example, in the United States, where you do have for funds and hedge funds the notion of qualified custody. This is actually something that is currently being looked into by the SEC. And clearly, the regulation is from 1940. I don't know. I think that IBM just released their first computer back then. So things need to adapt.
That's true. Cryptocurrency is a new type of asset and probably requires a new set of regulatory frameworks to adopt to it. And in this case, it's the technology is maybe slightly ahead of where rules are. Like you said, funds need to have qualified custodians, when in fact, I think we've done a good job of articulating here why, as you call it, direct custody may actually be better serving both from a security standpoint and even for acting as a fiduciary for their investors. Mike, I wanted to switch gears a little bit. It's not on the script, forgive me, but I think we've been talking about institutional adoption, but you also mentioned earlier about retail, and self-custody is probably one of the bigger challenges, I think, that needs to be overcome for really next billion users, as they say, to adopt crypto. So how do you see more people like my mom being able to do self-custody, and how do you see that taking shape?
Yeah, so that's a good question. I think that we've seen traditional approaches, which I don't think scale to my mom or your mom, like using a hardware wallet.
Right.
And those are don't get me wrong, those are very secure, high-end technologies, There is nothing wrong about those hardware wallets, but there are two main issues there. One is that the user experience is just suboptimal. And the second issue is really that there is no the backup, right, or the recourse around losing that device or something like that is quite hard. So I do think that MPC in that context, and there are a few companies that basically creating breakthroughs, and I know that there are folks that are working on that. That are basically adjusting creating some hybrid mode in where the MPC is being rolled out in masses to those consumers, and fairly similar to what Fireblocks is actually doing for institutions. You have the technology providers or the providers of the app, which usually sits on the mobile. They hold half of the key, basically like a share. The retail holds a share. There is the ability to backstop and prevent fraud, prevent hacking, prevent all kind of bad things that can happen on the mobile device, because the mobile device cannot basically operate by itself. And most specifically, there are also ways to basically create a stronger recoverability, which is also a property around MPC that we haven't discussed.
Right. Great. I can tell you, I would just say Liquid is one of those companies looking at how do we scale self-custody of crypto using MPC as the backbone. It's something we're working on, but and that'll be for our next DeFi, maybe DeFi 2022 conference. Michael, thank you so much. I really enjoyed the talk, and looking forward to seeing what's next in the industry and Fireblocks and continuing to show leadership in the space.
Thank you so much, Seth, and looking forward to continue working with you guys and partnering and all the stuff we are doing.